I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. We have another great show today, and we're going to talk about 401ks and qualified plans, and pretty much most of America has some type of retirement plan. And the big thing is we're going to talk about 9 mistakes to avoid. Jeff?
Yeah. Well, hello, Steve. Welcome to the show. It's great to be here on set here in our office in Pottstown as we do our show, Financially Speaking, on PCTV and the PCTVnetwork.com. 401ks. So the 401k is used a lot of times in a generic sense to mean a retirement plan through an employer. So if you're working for a company, whether it's a public company or a private company, generally there's some sort of a retirement plan that's available to you. And what we want to, I guess, first emphasize is that it's important to take advantage of that plan because generally there is some type of a match, company match. And secondly, it's easy to do. The money's taken out of your paycheck through payroll deduction. It automatically goes into your 401k account, and then you get some type of tax advantage, whether it's done on a pre-tax basis through like a traditional 401k, you're getting tax deferral, or if it's on in a Roth account, then you're getting tax-free growth. So it's really important to participate in these programs, and it's really built a generation of wealth, in my opinion.
And I think too, Jeff, when people make mistakes, they really don't know that they're making them. They just go and they make it happen, and they're not educated on it.
Yeah, or until it's too late.
Yeah.
Until it's too late, Steve. I mean, a lot, and we'll get into all this, but a lot of times you're getting ready to, we talk to people, they're getting ready to retire, and they just don't have enough to retire on. They didn't start early enough. They didn't contribute a lot into the 401k. Life gets in the way. You're raising children, and et cetera, health issues, whatever. But the 401k is really, I think, important because once you decide that you're going to contribute, and it's usually a percentage of your income. So I always tell people, start out with something, start out low, and then, gradually, every time you get a raise, every year, try to increase it and get up to, the maximum that you can contribute. But you're likely not to change your contribution. Like if you're contributing 3%, you're not going to say, well, this week we're only going to do 2%, because it's a pain to do that.
And now, we can talk a little bit later about now how companies now, we'll talk about that later in the Secure Act, so companies are increasing that. Let's get to the first one, and actually, I think this is the most common one.
Yeah, mistake number one, taking the money and run. So we can cue the old song by Steve Miller. I won't sing it, but take the money and run. What that means is, we're in a transient employment situation. People don't stay in jobs for a long period of time, and what we have found is that when people move from job to job, they're cashing out on these 401ks. So that creates a couple problems. First is you got to pay tax on that money if you take a distribution from a 401k. That's problem number one. And then problem number two, if you're under 59 and a half, you got to pay a penalty.
Yep.
You got to pay a 10% penalty. So that creates a problem as well. And then thirdly, if you're taking you take the money and run, take that distribution, it's really hard to save for retirement.
And I think people, if they are not working with a financial planner, they don't look long term, and they take that money, and the compounded interest on that is incredible. Let me go back to something, Jeff. When you said that now it's a more transactional. When you go back, like with my parents, is there were pensions. So there was a major incentive to stay at one firm for a long period of time, and now with pensions being almost not out there anymore, there's really no incentive to stay with the company for a long time.
Yeah, the game has changed. Retirement today is different than it was a generation ago, and we're seeing less and less of the pensions, the company pensions, and that means that the burden has shifted to the individual.
Yes.
And you're responsible now for creating your own retirement nest egg. So whether you're going to have Social Security, and I think the statistics on that is the Social Security generally gives you about a third of your income on average. Is that right, Steve?
Yes.
About a third.
Yep.
So then you got to figure out where you're going to get the other 2/3 from, and it's really going to come from your own savings, and the 401k is going to be a big part of that. So I think the sooner that people recognize that and start saving in the 401k, I think the better off everybody is. But I think I read somewhere that over half the people, when they change jobs, they cash out on their 401k. That's a pretty alarming statistic.
Yes. So when we get to number two, and it's leaving the money with your old employer.
Yeah, so we just said about how people are changing jobs, but and so if people aren't taking the money and run, they're leaving it behind, and that's not really an ideal situation either for a few reasons. Maybe there aren't the best choices in the old 401k plan. You tend to forget about it. You tend to forget about that 401k, and if you have the option to roll it over into an IRA. You roll it over into an IRA, you can manage it a lot better. You can manage the risk in there. There's a lot more choices. We're in a very dynamic, volatile market, and if you don't have a plan to navigate your way through that, that creates a lot of problems. So generally, these old plans that are you're in a 401k, they don't have the provisions to navigate through a very difficult market.
And another thing with leaving it the old plan is that when people get older, their risk tolerance can change. So maybe they got in when they were 35 or 40, and they left the job, and now they're 55. And their 401k is very aggressive.
Yeah, I mean that's true. There's usually no effort put into evaluating your risk, inside of a 401k plan. And certainly if the 401k plan was from an employer that you had maybe 10 or 15 years ago, then even more so, you're pretty much putting that on autopilot, set it and forget it. And it's just a common mistake that can easily be avoided.
Yep. And if we go to number 3, it's executing a rollover instead of a direct transfer.
Yeah, so that's an easy one to avoid. And the difference is, I think it's important to kind of go through what the difference is between a rollover and a direct transfer. So if you're doing a rollover, basically what happens is the employer gives you the money. You take constructive receipt of the funds, and then you fall under the 60-day rollover rule, which simply means that you have 60 days in which to put that money into a new retirement account, a new IRA. And if you don't do that, Steve, then that's all deemed to be taxable. So you want to avoid that. And the other reason is, from a tax perspective, if you're getting a check for this money, the prior employer is required to withhold taxes, okay? Because they don't know that you're going to put it into a new IRA account, so they're going to withhold taxes. Meanwhile, you have to put the entire balance of your 401k into the new IRA, or the new account, the IRA account. And if you don't do that, then what you don't put into the IRA becomes taxable. Okay, so that's one problem. The other problem is you have to prove to the IRS that you did this, right? Because the 1099 is going to say that it was a distribution. So this can all be avoided, Steve. This can all be avoided by doing a direct transfer. And when you do a direct transfer, the funds go directly from custodian to custodian. So if you have money in an old 401k plan and you do a direct transfer and just tell the old 401k plan to transfer the money to a IRA through a direct transfer, then you never take constructive receipt of the money, and therefore it becomes a direct transfer and not taxable.
A lot easier.
It's a lot easier. It's a lot cleaner. The IRS likes it a lot more because it's, the tracking is like, oh, we just did a transfer. You're tax deferred in the old account. Now you're tax deferred in the new account. The direct transfer.
Good.
Yeah, it's a simple thing, but yet it's still a very common mistake. That people just think, oh, just give me my money, and then, there are reasons to do the 60-day rollover, but generally speaking, the direct transfer is a much cleaner way to do it.
So if we move to 4, the company stock monster.
The company stock monster. So if you're working for a big company that has publicly traded stock, oftentimes they'll give you the option to buy stock through your 401k contribution. In addition, oftentimes when the company is doing a match, they'll match the contribution in company stock. So when people retire, we see that they have a lot of stock in their 401k. That presents some problems because we talked a little bit about risk earlier, and what that does is it creates unnecessary risk because the stock could be, it doesn't even have to be a risky stock. It could just be any stock, and it just adds undue risk to your portfolio. So, and we see this a lot, because we have some of the larger employers in the area, and we see, for whatever reason, whether it's through company loyalty or, that match that
Company loyalty is a tough one.
yeah, yeah. So we see, people that have large balances in their 401k plan. So the biggest example that comes to mind when I see this is about 20 years ago, there was a company down in Texas called Enron. You remember Enron?
Oh, yes.
So Enron was forcing their employees, well, the batch, I believe they were forcing their employees to buy company stock with their 401k contribution. They were forcing them. And then secondly, the match was also with company stock. And then to make matters worse, when you left the employee, you left employment with Enron, they were not allowing you to move the company stock. You had to keep it there until till they were 55.
I believe. Yep.
55. Okay. So that created all sorts of problems. And of course, they ended up going bankrupt. So then their stock wasn't worth anything. So that really, that is a big problem because that was, their life savings. So there was some legislation that came out of that, which now, you can't, companies can't force you into that. They can't be as restrictive as, forcing you to contribute to the company stock, and they have to allow you to get out of it when you leave, et cetera, et cetera.
And one thing we can thank Enron for is that when I first got in this business, the only way you could roll over a 401k is when you separated from service. And so you were stuck with what they had, whether it was stock or limited investments. But they actually were the root of the in-service rollover.
Yeah, so the in-service rollover is the ability to move the money from the 401k plan into an IRA before you separate from service, hence the name in-service. And it's usually, I'll make a general statement that usually it's available when you're 59 and a half.
Yep.
Okay, that's not a blanket rule. Sometimes you can do it earlier. Mm-hmm. I've seen cases where you can do it as early as 55. Yep. But the in-service distribution really allows you to move the money out of the 401k, put it into an IRA, and start to manage your portfolio more actively with better, I don't want to say better choices, but more choices. Yep. And I think the in-service distribution the in-service has been a real service to consumers, yes, to employees.
Yes. Oh yeah. So when we go to number 5, and just naming beneficiaries.
Yeah, so mistake number 5, failing to properly name beneficiaries. This is a big one, and this is really, we're really big on this at our firm. We're constantly checking beneficiaries to make sure that they're named properly. But you want to make sure that on all these accounts, whether it's a 401k account, whether it's an IRA that you hold, whether it's a life insurance policy or an annuity, anything where you can name a beneficiary, you want to make sure that the names on the beneficiary designations are exactly the way you want it. Because there's some misconception that if you have a will and you have the designation properly in a will, that takes care of everything. And that's simply not true. What the will does is it takes care of all the assets that operate through the probate system, anything that goes through probate. But what your will does not cover is the 401k or any other account where there's named beneficiaries. So, what are some examples of instances where we've seen beneficiaries not correct? Divorce, death, second marriages, blended families. There's all sorts of cases where we have to change beneficiaries. And whenever you're naming a beneficiary, you have two levels of beneficiaries. You have a primary beneficiary. Those are the people that stand first in line. Then you have contingent beneficiaries. So primary, and you can name more than one, right? You can name, let's say that your spouse has died, and you have 4 children.
Yep.
You can name your 4 children as primary beneficiaries. So then who would the contingent beneficiaries be in that case? Well, could be grandchildren. So you would name the grandchildren as the contingent beneficiaries. That way, if the primary beneficiaries predecease you as the account holder, then the money then goes to contingent beneficiaries. So naming properly, I would say failing to properly name beneficiaries is one, and then failing to continually monitor your beneficiaries, I think, is another big one. We see a lot of cases where, maybe the spouse has died and they didn't name a contingent beneficiary. So when that happens, then the default then goes to then it will default to your estate.
Yes.
And we have seen cases where you'll name the estate as the beneficiary. Like I worked on a case last year where the client was a widow and she didn't have any next of kin. So there was, a multitude of nieces and nephews and charities, and rather than name them all on the beneficiary designation, she simply chose to name the estate. Now, be prepared though when you do that, because that then triggers a taxable event on all these accounts that have tax benefits inside of them. So, for example, the 401k is tax deferred. So there's special rules if you inherit a 401k directly of how you can take the money and pay the taxes. Well, that all goes away if the money goes into the estate.
Yep.
So,
Good.
So the theme is make sure that your beneficiary is properly named and properly monitored.
Yep. Makes sense.
Makes sense.
So let's go to 6. And basically, I'm calling this chasing the market.
Chasing the market, trying to recoup losses or chasing performance. This could be the theme for 2023 after we had such a tumultuous market in 2022. But basically, what it means is you're constantly trying to chase returns, and we see this all the time. We have people come in and they're trying to chase the latest shiny object, whether it's the latest stock, the latest mutual fund, and inevitably the stock that did the best last year isn't going to be the one that's going to do the best this year. That's why it's important not to get into the whole rat race, if you will, of trying to time the market. It's much better from a planning perspective if you're using good asset allocation. Mm-hmm. So if you sit down and you assess one's risk, and then you allocate your investments inside of a 401k according to what your risk tolerance is, what your time horizon is, and we don't go trying to chase the market, because inevitably that's a battle that very few can win, because you have to have you have to have expertise as to when to get in and when to get out, and it's not something that we advocate.
Good.
It's too risky.
It's risky, yep. So we go to 7, and we have burying your head in the sand about retirement.
Yeah, so burying your head in the sand is a strategy that a lot of people use. And I think that what happens is when's the right time to start planning for retirement? The answer is like now, right away. You should be starting to build the foundation of your retirement. So if you're to use the most extreme example, if you graduate from college and you're taking your first job and you're 22 years old, you should be contributing to the company's 401k plan. Start right away. Discipline yourself to put the money in the 401k account. Take advantage of the company match. Do the proper asset allocation. Just follow a couple easy steps and invest for the future. If you don't do that and you say, well, I got to buy a car, or I got to pay off student loans, or you're getting married and you're going to start a family. There's always things that can get in the way in your investment life. But the retirement aspect of it, that's not going to go away, and we can't depend on pensions to take care of that. So you have to really be aware of controlling your own destiny there.
And we go to number 8, forgetting about a loan.
So the mistake about forgetting about a loan, most 401k plans have the provision to borrow money. Okay, so let's use the example again. You're 22 years old, you started putting money into a 401k. You did that for about 10 years. So now you're in your early 30s and you decide you want to buy a house. And you have to put down a down payment. So where are you going to get the down payment? Well, you can borrow money from your 401k. The problem is you got to pay it back. Okay, so when you pay back your 401k, that restores the account. And there's a good reason why you would borrow money from your 401k, but essentially you're borrowing money from yourself when you do that. But the flip side of that, and Steve, you might have some good insight into this, but you're really postponing your ability to save for retirement.
Yes, and if you leave your job, then it all becomes taxable.
Yeah, well, if you leave your job and you
take your money.
if you go back to mistake number 1 and take the money and run, then the amount of the loan becomes a taxable event.
Yep.
So you have to pay taxes on that amount. So that's problematic as well. But I think I guess the best advice we can give is, if you're going to take a loan from your 401k, you should immediately make plans to pay that loan back. Yeah, because you want to restore that money back into your balance, and you certainly don't want to be retiring with a loan on your 401k account.
And we get to the last one, doing it alone.
Doing it alone. Well, yeah. So the value here of not doing it alone is, if you're working with an advisor, a financial professional, the financial professional has experience in how these 401ks work, how the risk works. It's all about the phases of retirement of your, you while you're working, you're in the contribution phase of your financial life, and then when you stop working, you're in a distribution phase. And those are two very different phases. And you really need a financial professional to navigate that in addition to being able to navigate difficult markets. So by all means, you want to be working with a financial professional. So Steve, before we wrap up here today, we want to touch on a couple things. First off, we're going to put a slide up of all the in the news things that we've had over the last couple years through our public relations effort. Steve, you and I and Shannon have all been featured in various media outlets. But the exciting thing that is fairly new on the horizon is our retirement design lab, which I know you're excited about.
Yep.
And this is really an educational series, and we're going to put some dates up on the screen there. And we're going to be doing these all in different areas where we serve. But the Retirement Design Lab is really a 3-part program where we're doing two nights of workshop and then one in-office visit where we do some pretty intense one-on-one follow-up. So we're pretty excited about that. So if you're interested in attending one of our Retirement Design Labs, please reach out to us. We have we'll put our information up on our screen, our phone number, and our email address. So with all that, Steve, I think we covered a lot of ground today. The show went really fast, I thought. I think we could spend a lot more time talking about 401ks. But with all that being said, we're going to sign off. This is Financially Speaking.